Hello, everyone. I'm Bernadette Albury of Gateway Healthcare Solutions. I am the Chief Executive Officer, and welcome to Wealthcare Wednesday. Now, let's get started. Today, our topic will be regarding health plan types and denials. So, as we get started, let's first start with the first type of plan, which is commonly known as HMOs, which the proper name is called Health Maintenance Organization. Health Maintenance Organization plans are commonly with most employers, small groups, large groups, and private sectors, where you are assigned a primary care physician who serves as the main point of contact for all of your care. When you stumble into a service where you need to see a specialist based on a condition, you would be directed from your primary care and refer to a primary specialist, a specialist. That specialist would direct your care until they released you to see other specialists based on the care or the deemed need of your condition. Then you would be referred back at a later time to the primary care if needed, if it's, an onset condition, pregnancy, whatever the case may be. So with that being said, the pluses of the HMO is you have lower out-of-pocket expenses, you have lower co-payments, and you're able to see the providers, but it is restricted to the providers only under the plan. Some plans calls it now commonly known as open access, which is a lot of health maintenance organization plans where it gives you a little bit more flexibility with some groups. For larger employers, you'll see plans such as the open access where you have the flexibility of going to any provider under the plan, most times without needing a referral, or sometimes you will need a referral. Of course, you have to refer back to the primary care for those referrals, and it would based on the services that's needed that an authorization or referral would be required. So let's roll into the Preferred Provider Organization Plan, which is commonly known as PPO. A PPO is also flexible. It's chosen based on the healthcare provider you are able to see, but you'll have a higher copayment, higher out-of-pocket expenses. But the best thing sometimes with the PPO plan, you're able to have out-of-network services and a longer provider listing. And you do have the flexibility in most cases to see whomever you choose within the plan, but not needing a referral. Point of services plans, they are still around, which is called the POS plans. POS plans are a combination of the HMO and the PPO, which is similar to the open access plan that I discussed earlier. So plans like that is typically chosen with the primary care doctor. You could also see specialists. However, like most PPO plan, you could see providers outside the POS network. But with this plan, you'll pay more for the services that you need as well. Now, let's roll into Medicare. Medicare, we all know, is a federal health plan, federal insurance program that's for ages 65 and older, and younger can obtain Medicare based on a disability, if they have end-stage renal disease, and based on the disability need. Medicare is divided actually into 4 parts, Part A through D. Part A is your hospitalization. Part B is your medical insurance. Part C is the Medicare Advantage, which is offered through private insurance companies like Humana, AvMed, Cigna. They all have Part C plans. And Part D is your prescription plan, where your prescription coverage is generated through there. Now let's funnel into Medicaid. And Medicaid is a joint federal and state program. It varies state by state of the coverage type and style. It varies state by state, and it's based on qualifications of your income. And it's income-driven based for the criteria. Or it can be of an income of a low base disability, where you have a disability but you have low income, so you qualify for Medicaid as well, based on the state requirements of the poverty level or different sectors of the low income. Being pregnant as well, you can obtain Medicaid based on your family size or your income. Now, let's talk about non-payment commercial denials. Before we get into that, let's take a deep dive and let's talk about self-pay. Self-pay is when you are a private patient that pays the hospital, doctor, for your services or facilities. The No Surprise Act is a great attribute to self-pay patients because it gives you that option as a private pay patient to know there are no surprises. You're advised of what your costs will be in approximate. Each facility has the listing of services readily available either on their website or they have it somewhere known in the ER shown or the urgent care facility. And when they provide that, you have an estimate of what the services will cost based on what you're obtaining. Most times in the urgent care, it's near the opening where you do your registration. They have it visibly and they have different levels based on the services that you would need. So that's the beauty of the No Surprise Act. You're able to get an estimate of what your out-of-pocket expenses will be as a private pay patient. So now let's talk about non-payment commercial denials and how it can affect institutions such as hospital clinics, doctor's office, skilled nursing facilities, home health, different sectors. Non-payment of commercial denials can negatively affect an institution if the payer refuses to pay for those services rendered. This can happen in a variety of reasons. It could be for technical denials. It could be for medical necessity. It could also take into play for disputes of billing errors, services that didn't meet the criteria to be rendered. But these can all be overturned if correctly revised. You can always submit a corrected bill. You can always provide proof of medical necessity. That would be documentation supporting that the services were medically appropriate. If it's for no response to a technical appeal, which would be considered as a technical denial, which would be considered as no response to other insurance information or no response stating whether or not an accident happened. All you have to do is reach out to that patient via letter and let them know that the insurance needs that additional information. So all of that can be recovered. And these are some examples of just the surface of how you can restructure your organization and provide a cost recovery. So when a hospital experiences a high rate of non-payment commercial denials, as I said earlier, it could significantly affect and impact an institution financially. It could cause layoffs. It could cause a huge struggle and cutbacks on staffing and services, which we don't want that because the hospitals are used for the community. They make a difference in our lives. We're not said to want to get sick, but it happens in life. At some point or another, you have to go to the hospital for preventative services. You have to go for mammograms, prostate screenings, different services. And all those services require expenses. Of course, preventative service, the good thing about it with most plans, of course, there's no charge. But those services that require, like for services that you have an issue with the dense breast, that based on your plan type, they may cover it at 80%. I still have out-of-pocket expenses. And if that carrier denies the entire claim, then that's revenue loss if it's not recaptured. We want to make sure that facilities are given that opportunity to recover claims that were lost with that recovery, that revenue. So these are just small strategies on how to recover lost revenue. So in order to minimize this impact of non-payment from commercial denials, facilities can work to improve their billing and coding processes to reduce these errors, like I mentioned earlier, which could lead to recovery of revenue, which can give cash flow, and that's what we want. To resolve these disputes over payments, a great way to set that up will be an alternative as a payment model, such as providing structures for value-based care models, reduce the risks of denials by focusing on high quality, cost effective care, and training staff members on how to recapture those denials with trainings, providing monthly services and meetings with payers to have these discussions because it's very important. Having these conversations makes a difference with your organization to recover and increase your cash flow. So as we wrap up, this is that time now to make this video as to an end. I would like to thank you all for joining me for Wealthcare Wednesday and look forward to hearing from you or seeing you next Wednesday. It is our goal to continue to providing episodes to value other facilities with information and knowledge for better understanding of health insurance plans. And they can gain this knowledge to increase their cash flow. And that's the ultimate goal. So see you next time. And thank you for joining me on Wealthcare Wednesdays. Take care.